Hello everyone, I hope you guys are doing well and your studies are going in full swing. In today's video, we are going to discuss about the CA final AFM RTP for January 2026. Now, we will be discussing all the important questions or the slightly new or different questions that are there in this RTP, which to be honest are relatively less if you compare it with the RTP for financial reporting of Jan 26, which I would strongly recommend that you review. The link for that I'm just sharing as well in the description. So just ensure that you review the FR RTP, which has a lot more adjustments, and in AFM RTP, whatever it is, we will discuss everything in this video. So over here, I've just marked out the questions, including the case study questions, which are slightly different or which might require a bit of practice. But having said that, most of the questions are either direct repetitive questions, or even if they are slightly different or new questions, they are something which can be easily managed based on the material that you have done. So we'll not spend a lot of time over here. We'll just keep it quick, precise, and such that your Jan 26 RTP is done. At the back of your mind, you should be clear that okay, I've done this RTP in the best time efficient manner. Okay, so let us get started. Again, we will do the descriptive questions first and we'll come to the case study based MCQs later. So the first of these questions that we want to review is question number 3. This is on advanced capital budgeting. This is a typical project evaluation where we need to figure out whether it is worthwhile taking the new project or not. SS company is considering the replacement of its existing machine with the new machine. The purchase price of the new machine is 26 lakhs. So this is my cash outflow. And the expected life is 8 years. The company follows straight line method of depreciation on the original investment. Scrap value is not considered for the purpose of depreciation, which means if I were to depreciate, this is 26 lakhs divided by 8. This is 3.25 lakhs. Let us say this is your depreciation, which would be 3.25 lakhs. The other expenses to be incurred in the machine are as under. So you have the installation charges, okay, so that may be capitalized into the cost of the machine, and hence your depreciation number may have to be recalculated. Fees paid to consultant for buying the new machine. Now these are initial costs which are directly attributable and hence they need to be capitalized, which means your cash outflow initially would be 26 lakh plus 9,000 plus 6,000. So maybe 26 lakh 15,000. Additional working capital is 17,000, which will be released after 8 years. Okay, so this will be an initial cash outflow as well. The written down value of the existing machine is 76,000 and its cash salvage value is 12,500. The dismantling of this machine would cost 4,500, which means the net in hand what you will get is the net sale proceeds, which will be probably 12,500 minus 4,500, that is 8,000. The annual earnings before tax but after depreciation. Clearly this is given before tax but after depreciation. Even if the word earnings were given, that is after depreciation, from the new machine would amount to 3,15,000. Income tax rate is 35%. The company's required rate of return is 13% and you have been given the present value factor. So if I were to calculate the present value of my cash outflows, my initial investment would be, I think, 26 lakh 15,000. On working capital, I will spend another 17,000. Let us say if I were to take this in thousands only rather than lakhs, so this is 2615 and this will be 17,000 of initial working capital investment. Now apart from that, there will be a cash inflow in the form of salvage. So over here you will get 12,500 minus 4,500, that is 8,000. However, that is 8,000 for a machine which in your books is 76,000. So over here, if I were to calculate the sale proceeds, which is basically 8,000 minus the WDV, which is around 76,000, that results in 8 minus 76 and a 68,000 loss. Now loss into a tax rate which is given to you as 30%, 68 into 30% will give you around 20,400. Now this is 20,400 of tax savings, and as a result, if I were to calculate the initial cash outflow, this will be around 2632, let's say sub point A. Now when you look at PVCI, for example, your initial salvage value, which will be 12,500 minus 4,500, that is 8,000, plus tax savings on the capital loss. If I'm not wrong, this is 20.4. No, this is 35%. So this is into 35%, 68 into 35%, and this is 23.8. So this is 23.8. So if I were to total both of these, I will get an immediate cash inflow of 31.8. This is sub point B. Now apart from this, there will be annual cash inflows, which will be profit before tax of 3,15,000 minus tax. So this is 3,15,000 into 35%. This is 110.25, and hence that will give you PAT of around 204.75 plus depreciation. Now when I calculate depreciation, this is 26,15,000 divided by 8, which is 326,875, and hence your annual cash inflow will be around 531,625. There is no other inflation or anything, and hence you will directly multiply it by the present value annuity factor of 4.8, which is over here. So this is into 4.8, and there you go, 2551.8. So if I total this up, this is 2551.8. This is sub point C. This is also your cash inflow. Cash inflow, cash inflow. Other than that, there's also release of working capital. Release of working capital, which is 17,000, that will be released into 0.376. So this is 17 into 0.376, 6.392, sub point D. And as a result, if we were to go to C, this will be, if I were to find the NPV over here will be your PVCI 31.8 plus 2551.8 plus 6.392 minus your PVCO. So this is my PVCO minus 2632, and hence there is a negative 42. I think since the NPV is negative 42, the viability of the project, well, it has to be rejected. So if I go to see, in this particular case, the NPV is negative, and hence the project should be rejected. If I quickly try to scan through the solution once over here, if you go back into your RTP, okay, so over here, if we review, ultimately, let me just see if, yes, so this is around 42,000 negative, and hence the project is not viable, it should be rejected. Now, once you are done with this question, a lot of the other questions are exactly similar of what is done. Like question number 4 is that question on buyback. I think this is around question 70 or 71 of our valuation. This is regarding bond valuation. Question 5, I think this is also question number 7, I think 7 or 8 of the material, nothing new. This is from a recent RTP or an exam question in your economic value added. I think we have added it somewhere at the end of your economic value added section. So there's again nothing new over here. This is a question which institute is preferring to ask these days. It is based on the index futures hedging, question number 14 that is there. So I'm just, I mean, whether you have taken it from us or if you have done somewhere else, this is these types of questions would have been covered. So I'm not kind of taking my time in discussing the same. When you look at interest rates, a very typical, very common questions regarding caps and floors. In this case, I think a collar strategy. I think question number 8. And in portfolio, this is on arbitrage pricing versus CAPM. Again, a very common question. This is something that you would have done, so we are not touching that again. When you look at question number 10, this is on early delivery. Early delivery, it's a question where the banker should take early delivery, and if the banker takes early delivery, what will be the cost is something that is discussed over here. And then there is question number 11. So even in question 10, there is a sub point 1 which is exactly same, I think, with question number 53 or 54. But there is a question sub point 2 also which says if you deploy these funds in USD and earn a return of 3%, which option would be better, deliver to the bank or invest in USD? It is like saying that if you get the dollars, One option is you go to the bank and take early delivery, in which case you will have to deposit the rupees that you get in the Indian rupees in INRs. You will find the cash flow in INR after doing the early delivery. Compare it with if you don't take the early delivery from the bank and you take the money from your client and deposit in the US and then do the original transaction, then what will you get? So this may be an additional point, but it is kind of a continuation with question 10. So point 2 is something which might have a bit of a difference, but other than that, I would say all the other questions are based on something that you would have kind of done. Now you look at question number 11. In question 11, there is an XP Pharma who has acquired an export order for rupees 10 million from European company. The company has also planned to import bulk drugs worth 5 million from a company in UK. So there are two things. There's an export of 10 million rupees and there's an import of 5 million rupees. The proceeds of export will be realized in 3 months. So this will come in 3 months, and the payment for imports will be due in 6 months. So this will come in 6 months. From now, the invoicing of these exports and imports can be done in any currency. The invoicing of imports and exports can be done in any currency. Now this is a little unique. That is, it can be done either in dollars or in euro or in pounds at the company's choice. So you have 3 currencies. You have to figure out which currency should you take. The following market quotes are available. So you will have the bid and the ask for each of them. So you will try to find in which currency what will be the invoice value. Like for example, if there is 10 million euros and if you want to kind of price, so if I look at the export consignment and if I were to price it in dollars over here, what is the base currency? The base currency, for example, is the dollar. What will you do if you get dollars as a customer? You will end up selling the dollars, which means the banker will buy the dollars. The banker will buy the dollars, for example, at the bid rate, and hence the transaction, if you had to find, this will be, for example, at the dollar bid rate. So over here, you will try to find the invoice value. So for example, if it is rupees 10 million, I will say 87.1. So I will have to divide. So rupees 10 million divided by rupees 87.1 per dollar, and hence this is 10 million, that is 1 crore divided by 87.1. This comes to, let us say, $1,14,811, let us say. Now this is in dollars. So you have put this invoice. However, well, when the money is actually received, the rate will not be 87.1. This is an annualized premium. This is a per annum premium of 7%, which means 3 months later, premium, that means the base currency dollar will be at a premium. So 3 months later, the forward rate would be 87.1 plus, let us say, 87 plus 0.1 into 1 plus 0.07. But this will give you the rate after 1 year. I want after 3 months into 3 by 12. So this is 87.1 into let's say 0.07 into 3 divided by 12 plus 1, and hence this is what I believe 88.624. So this is 88.6243, which means if I were to convert this invoice in rupees, this will now be what? Into 1,14,811. So this is 1 crore, or what is this? This is a big number, 10,175,038 approximately. So when we do this calculation, in this calculation, well, you'll have 10 million or 1 crore divided by 87.1. This will give you the value of 1,14,810. The rate will now be 88.62. I mean, we took the longer decimal, but if I take this is 1 crore 1,74,000 and something. In a similar way, if I were to do the working for the transaction in euros. I will again say that the base currency is euro. As a customer, being an exporter, I would receive the euros. I would want to sell the euro. If I sell the euro, the banker buys the euro. The banker buys at the bid rate. Again, if you take 10 million or 1 crore divided by whatever is the bid rate, which is around 101.15, this will come to 98,863.07, the invoice value. Now, if I look at the annualized premium over here, the annualized premium would be, where is this? The annualized premium would be 6%, but this is 6% per annum, 101.15 into 1.06 into 3 by 12, that is, for example, 1.015, and hence this is 102.667 or 102.67 over here. So if you look at this, this is 102.67. So 98,000 ka invoice will give me 98,863.07 multiplied by 102.6, and then I actually get the money. If I convert it, it will give me 101.502. This will give me 101.74. So the dollar is better. And if I go into pounds, the last thing, it is the exact same working. If I go into pounds, I would say, well, the base currency is a pound. I want to sell the pounds because I'm an exporter. I will receive it. So the banker will buy it at 116.65. So this is again 10 million divided by 116.65, and this is 85,000 and 726 point something, 85,726.53. Again, if I were to take the annualized premium, it is 5% for 3 months. This is 1.0125, and hence 118.11 will be the case. So over here, you will have 10125. Now, you have been given a choice that whichever currency you want, you can quote the invoice in that currency. You would want to quote the invoice in that currency where you believe you will get the highest. So over here, I believe the highest is in the USD, and hence for the export contract, I will denominate the invoice in the US dollar. Now, if I look at the import contract, what happens in case of an import contract? Import contract, first of all, is for a 6-month tenure. Still, if I go to say for an import contract, this is for 5 million, that is 50 lakhs. I can say that the base currency is still the foreign currency. Base currency is the currency in the denominator of the exchange rate quote. So if I look at the import contract, my base currency, for example, is the dollar. As an importer, I want to buy the dollars. So the bank over here would end up selling the dollars, and you can sell the dollars at the dollar ask rate. So dollar ask rate is 87.20. So if I want to denominate the invoice, for example, in dollars, so 5 million is 50 lakhs, 50 lakhs divided by 87.20. So 50 lakhs divided by 87.20 will come to $57,339. However, you don't have to pay this now. You have to pay this after 6 months. This is slightly different. This is after 6 months. After 6 months, the rate would be what? Well, 87.2. Just a second. So your forward rate or the expected spot rate would be 87.2 into 1 plus 0.07 into 6 by 12. So this is 87.2 into 1.035, which is 90.252, which means if I were to find out how much will be the amount, so this will be into 57,339.45, which is, you'll have to pay 51 lakh 74, it's not 51 lakh, I think this is what these decimals are. Yes, 51 lakh 74,885 approximately, right? So this is in case of dollars, and if you can understand what is to be done for dollars, you will understand for the other currencies as well. So over here, this is $57,000 invoice, 90.25, and if I take 51 lakh 74,885, exactly. Now the same working will go for the euros, where I will again take the ask rate. I will divide it so that the rupee gets cancelled and your answer remains in euros. 49,000 invoice. There's a 6-month 6% premium, which means the currency will be 101.20 into 1.06 into 6 by 12, so that is into 1.03, so 104, and that will give you 51 lakh 50. And the last case, all said and done in a similar way, this would be 51 lakh 25,000. As an importer, I would prefer to pay the least, and hence the import bill I will place in pound and the export bill in dollars, so that I can get the highest cash inflow from the export and have the lowest cash outflow for import. So cash inflow is highest in case of dollars, so export should be in dollars. Cash outflow is least in case of pounds, so the import should be in pounds. If you are able to crack one of these rows in export and one of these rows in import, I believe the others you can calculate. Okay, so this is regarding question number 11. I believe when you look at question number 12, they have told you which currency should be used for import or export. Exchange rate calculation should be up to 2 decimals, so you can take up 2 decimals. This is a good thing that has been happening recently. Like even if you look at the September 25 paper, they have told you clearly everywhere how many decimals to be used, and we thank the institute for that, because there was so much of a ruckus behind how many decimals to use, but now the institute is trying to be as much as clear as possible. Now when you look at question number 12, mergers and acquisitions, there's a bit of, I would say, incorrect question framing over here possibly, but nevertheless, X is studying possible acquisition of Y by way of merger, and the following data is available for both the companies: market cap, GP ratio. You have something new. You have the inventory turnover ratio, then the debtor turnover ratio, then you have debentures, number of equity shares, operating expenses, corporate tax rate, closing stock. Okay, you have closing stock and you have debtors. Now if you look at inventory turnover ratio, the formula for inventory turnover is typically COGS upon inventory, which means if I have the turnover ratio, if I have the inventory, that means I can find the COGS. So if I look at the turnover ratio into inventory, that will give me COGS. Like in the first case, if my turnover ratio is 5 times and the inventory is, for example, 15 lakhs, so this is 75 lakhs, which is my COGS. Okay, from the COGS, and if I have the GP margin, I can find the sales. So if GP margin is 20%, COGS must be 80%. So sales are how much? So sales over here would be 75 divided by 0.8. 75 lakhs divided by 0.8 comes to 93 lakhs 75,000. So this must be my sales for company X. In a similar way, if I were to do for company Y, this is 5 lakhs of inventory into 4 times, that is a turnover ratio, that is 20 lakhs, and again that is my COGS divided by 0.8. 80% is my COGS, 20% is GP margin, so 100 is sales, so this must be 25 lakhs. So over here this sales is 25 lakhs. Now honestly, the problem over here is institute has done it based on the inventory turnover, which is fine. From the inventory turnover they found the COGS, and from the COGS they found the sales. That is absolutely fine. But the problem is some student might start with debtors turnover and debtors, because the formula for debtors turnover typically is credit sales upon debtors is the debtors turnover. So theoretically what you will get is the credit sales, but there can be cash sales as well, and hence maybe the institute has preferred the inventory turnover workings over the debtor turnover, because the numbers don't match. Because if I look at the debtors turnover of 10 lakhs into 3, 10 lakhs into 3 will come to only 30 lakhs. So the sales are coming to 30 lakhs. Maybe one can argue that this is the credit sales, because debtors come out of credit sales only, not out of cash sales. So maybe the credit sales are 30 lakhs, the other may be cash sales. That is a possible explanation, but institute has focused on the inventory turnover ratio to find the sales. We will also do the same. Okay, you are required to calculate the swap ratio based on EPS and MPS at 40% and 60%. Now if I had to find the exchange ratio for EPS, I need to find the EPS. So over here, let's say for the first company, 93.75 lakhs is my sales, and if I want to find my GP, 93.75 lakhs into 20%, this is 18.75 0.75 lakhs. This is GP. Now, honestly, why would I even want to find the GP? I have the operating expenses ratio directly given as 86%. So over here, I can directly find the EBIT at the rate 14%. For example, 93 lakh 75,000 into 14% comes to around 13 lakh 12,500. From this, I will subtract the interest. Interest over here is 10 lakhs into 12%. This is 1 lakh 20,000. You will get a number that is EBT minus tax. The tax rate is 30%. And hence, if I were to find the PAT, minus 1 lakh 20 minus 30% comes to, I believe, 834,750. Now I need to divide this by the number of shares, which is 1 lakh, and hence 8.3475 will be my EPS. Okay, this is for the acquirer. If I look at the target, 25 lakhs into again 78% cost, which means 22% profit margin. So this is 5,50,000. 5,50,000 of EBIT. From this, you will subtract 10% of 14,40,000. So this is 1,44,000 of interest, and from 1,44,000 minus 30%, this comes to 2,84,200. Divide this by 1 lakh. No, divide this by 60,000, the number of shares, and hence 4.73 probably would be my EPS. So if I want to find the exchange ratio, this is a favorable factor, and hence target upon acquire, this is 4.73 upon 8.3475. 4.73 upon 8.3475. This is around 0.5666. That is based on EPS. If I want to take based on market price, 75 lakhs divided by 1 lakh. So market price is around 75, and 90 lakhs divided by 60,000. So this is around 150. Target by acquirer, this is probably I think 2:1, is it? So if I were to look at the swap ratios from this working, so you can find for the EPS, this is 8. This is a printing mistake here. This is 8.34. So 4.74 target upon 8.34. This will give you around 0.56 or 0.57, and 150 upon 75. This is equal to 2:1. Now the weights given are 40 and 60. So this is 0.57 into 40 and 2 into 60. And hence this is 1.427 or 1.428 as I guess maybe. This is your weighted average swap ratio. So that's about it. Just using those turnover ratios and realizing that if there's a debtor turnover, it gives us credit sales. Inventory turnover in such a case will give you a better answer. So this is 1.427 or 1.428 swap ratio. Post-merger EPS, this should be easy. If I can take the post-merger PAT, this is 8,34,750 plus this is what, 284,200 divided by 1 lakh plus, if I look at 60,000 into 1.427, this will be 85,620. So this will be, I believe, 834,750 plus 284,200 divided by the total comes to around 6.03, 6.028 or 6.03. This will be my post-merger EPS. Post-merger market price, assuming P ratio of X remains the same. So what is the P ratio? 75 upon 8.34. Let us say around 75 upon 8.3475. Maybe this comes to around 8.98 or around 9 approximately. And if you multiply this by 6.03, that comes to around 54 point something as the post-merger market price. So if I look at the solution for this, this will be maybe 8.99, which is the PE ratio of the acquirer. If you want to find the post-merger EPS, this is 6.03 and 54.21 would be the post-merger market price. The next part of the question asks you to calculate the post-merger gain or loss in EPS. Now that will be the pre-merger EPS minus the post-merger EPS. Now if I were to take the post-merger EPS, this is 6.03 for the acquirer minus 8.34 approximately. And over here, this is pre-merger, this was 4 point how much? 4.73. Okay, now if I take this, this is 6.03 into 1.427 effectively. 6.03 into 1.427 comes to around 8.60, which means there's a big loss for the acquirer. 6.03 minus 8.34, around 2.31 loss, and there is a big gain, 8.6 minus 4.73, this is 3.87, a huge gain. So when you look at, let us say, the workings, you will find shareholders of X will lose EPS. Y stands to gain. Okay, just a second. How have they calculated this? 8.34 compared with 6.99. Post-merger EPS is 6.03. There seems to be some mistake over here because post-merger EPS actually seems to be 6.03 rather than 6.99, and hence there seems to be a bit of a difference in the solution. Okay, so I guess, I mean, there's no question which is very different as compared to what you have done. This is a very basic, it's like a very basic, I think like a question 1 or 2 of a mutual fund where you just have to sit and calculate the NAV. This is on financial policy, which we have done in valuation, where you just need to draw the income statement from the given data and the growth rate. I think this is again similar to a question that we have done in our valuation. Nothing new over here per se. It is based on preparation of income statement, more of an inter-year type of a question. And then there are some theory questions which you can refer the compiler. I'll share the link as well. So this is on pitch presentation, challenges to efficient market theory, etc. So you can review theory in any case. Okay, whichever sources you get to review theory, you might as well go ahead and review the theory. Now when you look at the case study based MCQs, this is the same as one of the earlier RTPs, I believe, on securitization. They've asked you regarding a securitization case. This is discussed in one of the earlier RTPs as well. And then there is an international financial management case study, which to be honest is similar to, I think, one of your case studies in your MCQ case study booklet if you have done. If you have not done, we are just discussing that separately. A US parent company has subsidiaries in France, Germany, UK and Italy. The amounts due to and from the affiliates is converted into common currency, that is a US dollar, and entered in the following matrix or table as a case may be. So inter-subsidiary payment matrix is given. This is in dollar thousands. So this is the paying affiliate. These are the guys who are going to pay. And this is the receiving affiliate. These are the people who are going to receive. Okay. So maybe when you see this 120, it means the French company is paying to the German company. That is what it means, the paying affiliate and the receiving affiliate. The treasurer of the US parent company is suggesting that by applying multilateral netting system, which means across the different geographies, you will net and just make the net remittances. The company can save a lot of transfer or exchange costs, and the company's board agrees to the proposal. Okay, before applying multilateral netting, it is necessary to apply unilateral, bilateral. Okay, when you look at this netting principle, if one country has to pay to the other and it has to receive from the other, you will try to net off first on a country to country basis. So you will first do what is called as bilateral netting rather than doing all of these nettings together at one go. At this point, it might be slightly tricky. So, we'll try to understand with the next numericals as well. So, abhi ke liye just remember bilateral netting through, okay, like for example, then before I go to the second MCQ, the net payment or net receipts for France after netting off shall be. So, when I look at France, France would net pay. France has to net pay 480, gross pay, total 480. And it has to net receive 400. So when I look at the net position in France, I will end up $80 pay. Similarly, when you look at Germany will have 260 minus, so that is it is going to receive, and 360 it is going to pay. No, sorry, 360 it is going to receive, 260 it is going to pay. So over here for Germany, the receiving is 360, paying is 260, and hence $100. Germany will actually receive. France mein it will have to receive 400 and pay 480. Acha, when I look at UK, it will receive 420, but it will have to pay 320. So UK is also $100 receiving, and Italy will receive 380 but pay 500. So Italy ends up paying 120. Now the beauty over here is, if I total up the paying, which is 120 and 80, that is 200, that equals the receiving, this is 200. So basically on a totality basis, if these subsidiaries end up paying 200 and the recipients receive 200, the transactions kind of are settled. So over here, this is what I mean by the net payment or receipt. So net payments or receipt for France after netting off would be, well, France over here will net pay 80. So net payments of 80,000, answer should be B. When I look at net payments or receipt for Italy after netting off, Italy will pay net 120. Net payment 1,20,000. Okay. Now point 2 says through multilateral netting these transfers will be reduced to. So ultimately, ideally what will happen is, ideally there will be total 1560 of transfers. If there was gross, that means all the paying companies will pay 480 plus 260 plus 320 plus 500. So they will pay 1560 and the receiving companies will receive 1560. Instead of 1560, the deal is getting done at merely 200, and as a result, through multilateral netting, the transfers amounts are reduced to $2 lakh. That is 200,000. Had this not been the case, it would have been 1560. So suppose if the transfer charges are 0.01% of the amount transferred, then by applying multilateral netting, there would be a reduction in the overall transfer cost by, well, if I were to do a gross transfer, my gross transfer would have been 1560 into 0.01%, this would have been the charge. However, if I do the netting, my net transfer ultimately is only 200 into 0.01%. So this will be my charge. So this is 1560 into 0.01%. This is 0.156. 200 into 0.01%. This is 0.02, and hence you will end up saving 0.136. Now this is, I think, in thousand, so into 1000, this is $136, and hence your answer should be A. Is it 136? Let me just confirm it once. It should be, yes, $136. Answer should be A. So this kind of takes care of your second case. I mean, to be honest, if we want to quickly discuss, since we have a bit of time, if you want to quickly discuss the first case study as well, we can do that. It's actually discussed earlier in one of the securitization RTP videos, but nevertheless, Growmore is an NBFC, is in the need of funds, and it sold its receivables to MAC Financial Corporation for 100 million. So this is sold to MAC. MFC creates a trust for this purpose called a general investment trust, through which it issued securities carrying a different level of risk and return to the investors. Further, this structure permits the GIT to reinvest the surplus funds for short term as per their requirement. So MFC also appointed a third party called a Safeguard Private Limited to collect the payment due from the obligator. Obligator is whoever is the borrower, and pass it on to GIT. So this is kind of a person, an agent who is appointed. It will also follow up for defaulting obligator, and if required, initiate appropriate legal action against them. So this is your general theory case for the purpose of securitization. So there are a few MCQ based case studies. So over here what is happening is, there is an NBFC who is in need of money. So the NBFC, who is called as Grow More, it approaches MAC Financial Corporation, MFC, which is giving 100 million. Now, how do they raise 100 million? They have a trust called as GIT, and which is issuing certain securities. Now, these securities have different levels of risk and return to investors. Now, this permits GIT to even receive surplus funds for short term as per the requirements. Now, in a pass-through certificate, what happens is whatever you collect, you have to transfer. This is not the case. Here you are tranching it based on the different levels of risk, appetite of the investors, and you can also invest funds. So this is not a pass-through certificate. A strip security is usually paying only interest or only principal, so you're stripping off and paying only a part, which is again does not seem to be the case. But a pay-through security is, I mean, this is not a debt fund per se, but this is not a debenture or anything, but this is a pay-through security where from the cash flows that you are getting, you are paying, but you're not passing through exactly what is collected. You can always invest and you can kind of structure as you desire. So this is like a pay-through security. The originator over here is MAC. Now the MAC is the person. See, the original lender was the NBFC, from which it has to collect a lot of money from borrowers. It transferred this to MAC, and MAC is the person who kind of formed a SPV, special purpose vehicle, which is the GIT. They appointed a receiving and paying agent who is, I think, Safeguard Private Limited, and then there were investors. But the originator of this transaction is MFC, that is MAC Financial Corporation. Safeguard is the receiving and paying agent. This is a special purpose vehicle. This is the originator. Okay, and Grow More is the original lender. Okay, so in the above scenario, Safeguard is, I think, receiving and paying agent. This is the fourth MCQ, and General Investment Trust is the special purpose vehicle, which is SPV. Which of the following statements hold true? When the yield to maturity in the market rises, price of principal only securities tend to rise. No, principal only securities, they are going to give you principal after 5 years. But if the YTM rises, bond price falls. So this is wrong. So if YTM rises, price of principal only securities tend to fall. This is correct. So if the YTM increases, as an inverse relationship, then the market price of the principal only securities, which are going to give you principal at the end, this will fall. So I think point B is the correct answer. When YTM falls, then price of principal securities, no, this is wrong, they will rise. When YTM falls, price of principal securities remain the same. This is also wrong, so your answer is B. So I guess that sums up the RTP for January 2026. I hope you have a good sense of what is there in the RTP, and we have tried to discuss the questions which have some differences in terms of adjustments, but net it is not a very difficult RTP or does not carry very completely different questions. So you can just quickly scan through this and proceed further. So that should be it, and again, wish you all the very best for your exams. Put in all your efforts and hard work, keep smiling, have faith in God, and I'm sure you're going to do well. Goodbye, good luck, and take care.